If you were standing at the center of the global financial system as it quietly reshapes your life, you wouldn't hear alarms. You wouldn't see flashing warning lights. You wouldn't feel panic in the streets. In fact, you probably wouldn't notice anything at all. Because the most powerful decisions in modern finance are not made on stock exchanges, in parliaments, or during elections. They are made slowly, deliberately, and almost invisibly, by people you have never voted for, inside institutions you've likely never heard of, far from Wall Street, far from Silicon Valley, far from public debate. In a quiet industrial city in Switzerland, there stands a building that doesn't look important, but is. It's cylindrical, brutalist, cold. It doesn't advertise power, it assumes it. Inside this building, a small group of central bankers and regulators meet to decide something deceptively simple: how much risk the entire banking system is allowed to take, and, by extension, how easy or hard it is to get a mortgage, whether small businesses can get loans, how credit flows through the economy, how bubbles form, and how crashes unfold. The rules they write don't make headlines, they don't get voted on, they don't appear on ballots, but they quietly determine the limits of the modern economy. These rules are called the Basel Accords, and whether you realize it or not, they shape your financial future every single day. The strange thing about the Basel Accords is that they were never designed to control the world. They weren't created as a grand plan. They weren't built to centralize power. They weren't meant to reshape capitalism. They were created to fix a problem, a real problem, a dangerous one. To understand how a technical safety rule became one of the most powerful forces in global finance, we need to go back to a time when banking quietly crossed a line without anyone fully noticing. In the early 1970s, banking was changing faster than regulation could follow. Money moved across borders instantly. Banks expanded internationally. Financial markets became interconnected in ways never seen before. But regulation stayed stubbornly local. Each country watched its own banks, assuming everyone else was doing the same. They weren't. And in 1974, that illusion collapsed. A mid-sized German bank failed, not at the end of the day, not neatly, but in the middle of global trading hours. Because of time zone differences, American banks had already sent money earlier that day. Before they could receive payment in return, the German bank shut its doors. The money was gone. No fraud, no conspiracy, no malicious intent, just a system that had grown faster than its safeguards. For the first time, central bankers around the world were forced to confront an uncomfortable reality. A failure in one country could instantly damage banks in another. There was no global emergency protocol, no shared standards, no agreement on how much risk was acceptable. So, in classic bureaucratic fashion, they did the only thing they knew how to do. They formed a committee. Not a government, not a regulator with enforcement power, just a group, a place to talk, to coordinate, to prevent chaos next time. Its mission sounded modest, make banks safer, but its implications would be enormous. For years, the committee debated quietly. They argued about probabilities, about historical crashes, about how much loss a bank should be able to absorb before collapsing. The discussions were slow, technical, boring, until they arrived at something deceptively simple, a number: 8%. Under the first Basel Agreement, banks were told they must hold capital equal to at least 8% of their assets. In simple terms, for every $100 a bank lends, it must keep $8 of its own money as a buffer. At first glance, this seemed responsible, even obvious. If a loan goes bad, the bank absorbs the loss instead of collapsing. Problem solved. Except, not all loans were treated the same. And this is where everything changed. The committee introduced a concept that would quietly dominate modern banking: risk-weighted assets.
The idea was logical. Some loans are safer than others. A loan to a government is different from a loan to a struggling startup. A home mortgage isn't the same as an unsecured business loan. So they assigned weights. Government debt, extremely safe. Mortgages, moderately safe. Business loans, risky. The higher the risk, the more capital a bank had to hold. On paper, this looked like intelligent regulation. In practice, it rewired incentives across the entire financial system. Because banks don't respond to speeches, they don't respond to intentions, they respond to math. And the math was now whispering something very clear. Lending to governments was cheap. Lending to businesses was expensive. No one ever said, stop funding the real economy. No one ever ordered banks to inflate housing markets, but the formulas nudged them there, quietly, relentlessly. Banks adjusted their balance sheets. Capital flowed toward whatever required the least regulatory punishment. Government bonds became attractive not because they were productive, but because they were efficient under the rules. Housing gained preference. Small business lending slowly lost priority. And all of this happened without villains, no secret meetings plotting outcomes, no evil masterminds pulling strings, just compliance, just incentives, just optimization. The system appeared stable, clean, under control. But stability has a hidden cost. When every major bank in the world is rewarded for behaving the same way, risk doesn't disappear, it concentrates. And that concentration was quietly building pressure inside a system that believed it had finally mastered uncertainty. By the time anyone noticed, the architecture was already global, the rules were already entrenched, and the people writing them were already convinced they were working. What began as a safety measure had become something else entirely, not a guardrail, a mold, shaping how banks thought, how they lent, what they feared, what they avoided. And this was only the first version, because banks, like water, always find the easiest path. And soon they would discover that rules don't just limit behavior, they create new behavior, sometimes far more dangerous than the problem they were meant to solve. Rules don't eliminate behavior, they reshape it. And when rules become complex enough, they don't just guide institutions, they teach them how to escape. By the early 1990s, banks around the world had fully absorbed the lesson of the first Basel Accord. Safety wasn't about making good loans, it was about looking safe on paper.
The capital rule didn't ask whether a loan made sense. It didn't ask whether the borrower could repay in a crisis. It asked one thing only: how is this asset classified? And classification, it turned out, could be engineered. Banks noticed something subtle but powerful inside the Basel framework. If a loan stayed on their balance sheet, it demanded capital. But if that same loan was sold to someone else, it simply vanished from the calculation. No loan on the books, no risk weight, no capital required. This wasn't illegal. It wasn't even dishonest. It was optimization. And it triggered a quiet revolution in how banking worked. Instead of holding loans for decades, banks began packaging them. Mortgages, auto loans, credit card debt, corporate loans. They bundled them together, sliced them into pieces, and sold them as securities to investors. This process became known as securitization. On the surface, it looked like progress. Risk was spread across the system, banks freed up balance sheet space, credit became cheaper and more abundant. But something fundamental changed. When a bank plans to hold a loan for 30 years, it cares deeply about whether the borrower can repay. When a bank plans to sell that loan in 30 days, it cares far less. The goal shifted, not loan quality, loan volume. This became known as the originate-to-distribute model. Make the loan, package it, sell it, repeat. Basel didn't tell banks to behave this way, but the incentives rewarded it. And once the system adapted, there was no easy way back. By the late 1990s, regulators could see the cracks forming. The original Basel rules were too blunt, too simplistic, too easy to game. Treating every corporate loan as equally risky made no sense. A global blue-chip company was clearly not the same as a failing startup. So the committee returned to the tower once again. This time, they promised sophistication. The next version would be smarter, more scientific, more precise. It would finally align regulation with reality. In 2004, they unveiled Basel II. If the first Basel Accord was a pamphlet, Basel II was a textbook. Hundreds of pages long, dense formulas, statistical models, probability estimates. The goal was noble: measure risk more accurately. Instead of crude categories, banks would now rely on credit ratings. If a borrower or security was rated highly by agencies like Moody's or Standard & Poor's, it required less capital. If the rating was low, the capital charge increased. On paper, this was logical. In practice, it outsourced the stability of the global banking system to a handful of private companies. 3 rating agencies now held enormous influence. Their judgments didn't just guide investors, they determined how profitable loans were, how much capital banks had to hold, and how much leverage the system could support. And the system trusted them completely. But Basel II went even further. The largest banks argued that they were too advanced for standardized rules. Their risk departments employed armies of PhDs. Their computer models were complex, dynamic, and supposedly precise.
They claimed they could measure risk better than regulators ever could. So they asked for permission to use their own internal models to calculate capital requirements. This became known as the Internal Ratings-Based Approach, or IRB. Regulators agreed. It was framed as progress, as trust in expertise, as modernization. In hindsight, it was catastrophic. Because allowing banks to calculate their own risk is like allowing drivers to set their own speed limits. And unsurprisingly, the math almost always delivered the same answer. Risk was low, capital buffers could be reduced, returns could be increased. Banks optimized relentlessly. They trimmed excess capital. They increased leverage. They trusted models that assumed stable markets, liquid conditions, and predictable correlations. The models worked beautifully, until they didn't. Europe embraced Basel II enthusiastically. By the mid-2000s, many of its largest banks were fully operating under the new framework, and the timing could not have been worse. Because at the same moment regulation became more complex, the assets filling bank balance sheets became more dangerous. The U.S. housing market exploded. Mortgages were issued at record pace. Loans were bundled into securities. Those securities were sliced into tranches, and the top slices received the highest possible rating, AAA. Under Basel II, that rating mattered more than reality. A AAA-rated mortgage security was treated as extremely safe. It required very little capital. Banks could hold enormous quantities without appearing risky, so they did. From Frankfurt to London to Paris, banks loaded up on American mortgage bonds. On paper, they were well capitalized. Their ratios looked strong. Their regulators were satisfied, but the risk had not disappeared. It had been disguised. When the global financial system seized in 2008, the failure wasn't just institutional, it was philosophical. The belief that risk could be perfectly measured collapsed. The idea that complexity equaled safety was exposed as an illusion. And yet the response was not introspection, it was escalation. Regulators concluded that the problem wasn't the framework itself. The problem, they said, was that the rules hadn't gone far enough. Banks had been too free, too flexible, too clever. So once again, they returned to the tower. This time, nuance disappeared. The world was burning. Credit markets were frozen. Governments were panicking. And in moments like that, restraint looks irresponsible. When the global financial system collapsed in 2008, nuance died. Banks were failing, credit markets froze, trust evaporated almost overnight. In moments like that, there is no appetite for subtlety. There is only one question that matters. How do we make sure this never happens again? The answer regulators reached was blunt, uncompromising, and absolute. Banks would not just be safer, they would be fortresses. This was the birth of Basel III. Basel III emerged from the wreckage of the crisis with a radically different philosophy from its predecessors. Basel I tried to create guardrails. Basel II tried to measure risk precisely. Basel III gave up on precision entirely. Its goal was no longer to understand risk. Its goal was to survive it. The new rules were finalized in 2010 and rolled out gradually over the next decade. And unlike earlier agreements, this one was not a negotiation. It was an imposition. Banks were forced to hold far more capital. Equity buffers were thickened. Loss-absorbing capacity became the obsession. On top of that, regulators introduced something that cut through all the sophisticated modeling, a leverage ratio. No formulas, no risk weights, no internal models, just a hard limit on how much debt a bank could take on, no matter how safe it claimed its assets were. This alone fundamentally changed banking. But the most transformative rule in Basel III had nothing to do with capital. It had to do with cash. Regulators studied the collapse of Lehman Brothers obsessively. Lehman didn't fail because it owned worthless assets. It failed because it couldn't turn its assets into cash fast enough. It died of dehydration. So Basel III introduced a rule born from pure trauma, the liquidity coverage ratio, or LCR. The idea was simple. Every bank must hold enough high-quality liquid assets to survive a severe stress scenario lasting 30 days. In plain English, banks were forced to keep a massive emergency fund, cash or assets that could be turned into cash instantly, just in case the system panicked. On the surface, this sounded like common sense. Who wouldn't want banks prepared for a run? But finance has no free lunches, and the LCR quietly rewired the entire business model of banking. Under Basel III, not all assets counted equally toward liquidity. The best assets, the ones that satisfied the LCR most efficiently, were government bonds, U.S. treasuries, German bunds, sovereign debt from major economies. These were considered high-quality liquid assets. Loans to businesses didn't qualify. Trade finance didn't qualify. Lines of credit to companies didn't qualify. They were considered illiquid, penalized. And once again, banks responded exactly as the incentives demanded. They shifted. Balance sheets filled with government debt. Cash reserves grew. Lending became cautious, selective, procedural. Banks stopped behaving like engines of economic growth. They started behaving like storage vaults. This transformation didn't happen overnight. There was no announcement, no dramatic turning point, just a slow, steady retreat from risk. Since 2010, banks across the U.S. and Europe dramatically increased their holdings of sovereign bonds. At the same time, lending to the real economy, especially to small and medium businesses, stagnated. The system became safer, but also colder, more rigid. And that rigidity created something regulators hadn't fully anticipated, a safety paradox. By forcing banks to hold large quantities of government debt to meet liquidity rules, Basel III tied banks even more tightly to the fate of the state. If government bond prices fell, bank balance sheets would suffer. Theoretically, this wasn't a problem. Sovereign debt was considered risk-free. Governments could always print money. Default was impossible. But reality, once again, refused to cooperate. In the early 2020s, inflation surged. Central banks raised interest rates aggressively. And when rates rise, bond prices fall. Hard. Assets that were supposed to be the safest in the world suddenly generated massive losses.
We saw the consequences in real time. In 2023, Silicon Valley Bank collapsed, not because it had taken reckless bets, but because it had followed the rules. It held long-term government bonds. Rates rose, bond values fell. Depositors panicked. Liquidity vanished. The rules designed to make the bank safe were the same rules that destroyed it. But Basel III's most dangerous impact wasn't about individual failures. It was about what happened to the system as a whole. In their effort to make banks safer, regulators stripped away flexibility, the ability to improvise, to respond dynamically, to act as shock absorbers in moments of stress. This flaw revealed itself dramatically in September 2019. The overnight lending market, known as the repo market, suddenly seized. Demand for cash spiked. Interest rates exploded. In the old system, large banks with excess reserves would have stepped in. They would have lent cash, earned a profit, and stabilized the market. They didn't. They couldn't, because lending that cash would have pushed their liquidity ratios below regulatory minimums. So they hoarded it, even as the system screamed for relief. The result was a breakdown that forced the central bank to intervene with hundreds of billions of dollars. Basel III had made individual banks safer, but it had made the system more fragile. The shock absorbers were gone. This rigidity didn't stay confined to financial markets. It filtered down to everyday life. Compliance costs exploded. Every loan required documentation, modeling, justification. For banks, processing a small loan to a local business became almost as expensive as processing a massive loan to a multinational corporation, but the capital charge was higher, the margins were lower, the regulatory burden was heavier. So banks made a rational choice. They retreated. Branches closed. Small business lending dried up. Credit decisions became automated, impersonal. Computer says no replaced human judgment. And as traditional banks pulled back, something else began to grow, quietly, rapidly, outside the walls of regulation. A parallel system, one that didn't take deposits, didn't promise daily liquidity, and therefore didn't fall under Basel's rules. Risk, once again, hadn't disappeared. It had moved, and this time it was moving somewhere far harder to see. Risk never disappears. When it's suppressed in one place, it doesn't die. It adapts. It migrates. As Basel III tightened its grip on traditional banks, something critical happened, something regulators fully understood in theory, but underestimated in scale. The demand for credit did not go away.
Businesses still needed loans. Developers still needed financing. Infrastructure still needed capital. Growth still required leverage. But the regulated banking system was no longer designed to provide it. So the market did what it always does. It went around the rules. Outside the fortified walls of Basel-compliant banks, a parallel financial ecosystem began to expand. Quietly at first, then rapidly. It didn't look like banking. It didn't take deposits from the public. It didn't promise instant withdrawals. It didn't have branches or tellers. And because of that, it wasn't regulated like a bank. This ecosystem became known as the shadow banking system, not because it was secret, but because it operated outside the spotlight of traditional regulation. Shadow banking includes institutions that perform bank-like functions without being banks. They lend money, they use leverage, they transform maturities, but they do it using different structures: private credit funds, private equity lenders, non-bank mortgage companies, fintech platforms, asset managers offering direct loans. They don't rely on insured deposits. They don't face liquidity coverage ratios. They don't run stress tests designed by regulators, and that gives them freedom. As traditional banks pulled back, these institutions surged forward. When a mid-sized company needed financing, it no longer walked into a bank branch. It went to private capital. These lenders could move faster, structure deals creatively, price risk aggressively. They weren't constrained by capital rules built for deposit-taking institutions, and they grew fast. What emerged was a two-tiered financial system. Tier 1 was clean, regulated, and heavily supervised, traditional banks. They held massive quantities of government debt, they processed payments, they passed stress tests, but they did less and less real lending. Tier 2 was dynamic, opaque, and lightly regulated. This was where growth capital flowed, where leverage accumulated, where risk concentrated. From the perspective of regulators, this was deeply uncomfortable. They had spent more than a decade making banks safer, only to watch the most important lending activity migrate beyond their reach. But the irony went deeper. The same Basel rules that constrained banks also entrenched their dominance. Compliance became so complex and expensive that only the largest institutions could afford it. Entire divisions were built just to manage regulatory reporting. Smaller banks couldn't keep up. They merged, they were acquired, or they quietly disappeared. The institutions deemed too big to fail became even bigger, protected by a moat of complexity. Competition shrank, diversity vanished, the system became uniform, and uniform systems may look stable, but they are fragile. Meanwhile, shadow lenders operated without those constraints. They could fund projects banks no longer touched: commercial real estate, leveraged buyouts, venture-backed companies, infrastructure projects with long timelines. They filled the vacuum left by traditional banks. And from the outside, this looked like innovation. But beneath the surface, something familiar was forming. Shadow banks often fund long-term assets with short-term money. They rely on confidence, on steady inflows, on the assumption that investors won't all demand liquidity at once. This works until it doesn't.
The structures are legal, the risks are real, and the transparency is limited, which raises an uncomfortable question. If a major private credit fund collapses, will governments really stand aside? Or have we simply created a new class of institutions that are too big to fail without ever admitting it? Because these funds don't exist in isolation. They are deeply interconnected with the rest of the financial system, through pension funds, through insurance companies, through retirement savings. Ordinary people are exposed, often without realizing it. The risk that was pushed out of banks didn't leave the system. It just moved to places that are harder to see, harder to measure, and harder to control. This is the recurring pattern of financial regulation. Rules solve the last crisis. Markets adapt. New vulnerabilities emerge. Basel III didn't eliminate excessive risk-taking. It changed who takes the risk and where it lives. And now regulators face a dilemma of their own making. If they tighten rules on shadow banks, risk may migrate again. If they don't, leverage continues to build outside their line of sight. Either way, the system becomes more complex, and complexity is not the same as safety. What began as an effort to make banking safer has reshaped the entire financial landscape. Banks are no longer the primary creators of credit. They are custodians, utilities, gatekeepers. The real action has moved elsewhere. And that brings us to the deepest flaw in the Basel architecture, a flaw that has quietly grown more dangerous with time. Because beneath all the models, all the ratios, and all the reforms lies a single assumption, one idea so foundational that questioning it threatens the appearance of stability itself. Beneath every version of the Basel Accords, every formula, every ratio, every stress test, there is a single assumption so fundamental that the entire system depends on it. An assumption so powerful that questioning it threatens the appearance of stability itself. That assumption is simple. Government debt is risk-free. From the very beginning, the Basel framework treated sovereign bonds from major governments as the safest assets a bank could hold. Under Basel rules, these bonds often carry a zero risk weight, which means in regulatory terms they are treated as if they cannot lose value. This idea rests on a familiar logic. Governments control their own currency. They can tax, they can borrow, and if necessary, they can print money. So default, in theory, is impossible. And for a long time, this assumption seemed reasonable. But default was never the only risk. There is another kind of risk that matters just as much: interest rate risk. Bond prices move in the opposite direction of interest rates. When rates are low, long-term bonds look valuable. When rates rise, their prices fall. And when rates rise sharply, those price declines can be brutal. This is basic finance. Yet, for years, the Basel framework treated this risk as secondary, something that could be managed, hedged, or simply ignored. And that decision would come back to haunt the system.
As banks complied with Basel III, they did exactly what the rules encouraged. They bought government bonds, lots of them. U.S. Treasuries, European sovereign debt, long-duration bonds issued in a low-rate world. These assets satisfied capital rules. They satisfied liquidity rules. They made banks look safe on paper. Then the world changed. Inflation surged. Central banks raised interest rates faster than they had in decades, and the value of those safe bonds collapsed, in some cases dramatically. Long-term bonds issued at ultra-low rates lost huge portions of their market value as yields climbed. This wasn't a theoretical risk, it was happening in real time. But here's where the illusion began. Under accounting rules aligned with Basel, banks are often allowed to classify bonds as held to maturity. When they do this, they don't have to recognize market losses. Even if the bond is trading at 60 cents on the dollar, the bank can still report it at full value, as long as it claims it will hold the bond until it matures. In theory, this makes sense. If a bank truly holds the bond to maturity, it will eventually receive full repayment. But reality is rarely that clean. Banks don't operate in a vacuum. They face deposit withdrawals, liquidity pressures, market shocks. And when confidence cracks, assets that were held to maturity suddenly need to be sold. At that moment, the losses become real. But until then, they remain hidden. This creates a dangerous illusion. Capital ratios look strong, balance sheets appear healthy, stress tests are passed, but the strength depends on not looking too closely. If banks were forced to mark all sovereign bonds to market prices, many would suddenly appear far weaker, some even technically insolvent. The system's stability rests on collective agreement to look away. Regulators know this, and they are trapped by it. If they force banks to recognize losses all at once, they risk triggering panic. If they don't, the system continues to operate on distorted numbers. So they choose delay, forbearance, silence. The rules designed to enforce transparency have quietly institutionalized denial. This is why the banking system can look incredibly strong at the same time it feels increasingly fragile. Capital ratios are high, liquidity buffers are full, supervisors express confidence, yet central banks are intervening more frequently than ever, injecting liquidity, backstopping markets, quietly stabilizing cracks before they widen. The contradiction is striking. If the system is truly safe, why does it need constant support? If banks are well capitalized, why does liquidity vanish the moment stress appears? The answer lies in what the Basel rules measure and what they ignore. Basel is excellent at measuring known risks, the last crisis, the last failure mode, the last set of assumptions. It is far less capable of dealing with structural shifts. Sustained inflation, rising debt burdens, a world where interest rates stay high longer than expected. In that world, government debt is not risk-free, it is volatile. And volatility is poison for systems built on uniform behavior. The deeper problem is not that banks hold government bonds. It's that they all hold the same government bonds, the same durations, the same assumptions, the same vulnerabilities. This is the price of standardization, the price of compliance. And now the system faces a new complication. The global consensus behind Basel itself is beginning to fracture. The framework was built in an era of globalization, when money was assumed to be neutral and rules were assumed to be universal. That era is ending. After major sanctions froze central bank reserves in the early 2020s, many countries began to rethink their exposure to Western financial systems. They began to question why certain assets were privileged, why certain currencies sat at the top of the hierarchy, why global rules reflected Western priorities. As a result, divergence has begun. Alternative financial architectures are forming. Different standards are emerging. The dream of a single global rule book is fading. And yet, even as the world fragments, the Basel framework presses forward. Another update, another refinement, another attempt to perfect a system built on increasingly unstable foundations. Which raises the final and most important question, not whether Basel has made banks safer, but whether it has made the financial system brittle. At first glance, the global banking system today looks calm. Capital ratios are high, liquidity buffers are full, stress tests are passed. From the outside, the fortresses appear strong. But strength, in the language of Basel, has come to mean something very specific. It doesn't mean flexible, it doesn't mean adaptive, it means compliant. Banks are considered safe because they all look the same. They hold the same assets, they follow the same models, they respond to stress in the same way. And that sameness is the real danger. The Basel Accords are built on a quiet but powerful belief that risk can be measured, categorized, and neutralized by committee, that the future will behave like the past, that the next crisis will resemble the last one just enough for the formulas to catch it. History tells a different story. Crises don't repeat, they mutate. The system built to survive mortgage defaults may not survive a cyber attack. The rules designed around bank runs may not withstand geopolitical fragmentation. The capital buffers calibrated for credit risk may prove useless against a sudden collapse in shadow credit or a sovereign debt spiral. These are not theoretical threats, they are emerging realities. By forcing banks to converge on a single definition of safety, Basel created a financial monoculture. In biology, monocultures are efficient. They produce uniform results. They are easy to manage. They look stable. Until disease arrives. Then everything fails at once. Finance works the same way. When every major bank holds the same safe assets, financed in the same way, reacting to stress in the same way, the system loses diversity. It loses resilience. It becomes vulnerable to shocks that fall outside the model. We've already seen early warnings.
Bond markets cracking under rapid rate hikes. Liquidity evaporating when it's needed most. Central banks stepping in, not as lenders of last resort, but as the only resort. Each intervention restores calm, but each one also reinforces a dangerous dependence. At the same time, real economic risk continues to grow elsewhere, outside regulated banks, outside standardized models, outside the tower's line of sight. Private credit has exploded. Shadow lenders now finance businesses, real estate, infrastructure, often with leverage, often with opacity, often with maturity mismatches that look uncomfortably familiar. These institutions don't face liquidity coverage ratios. They don't run stress tests designed by regulators. They don't publish capital ratios for reassurance. And yet they are deeply connected to the rest of the system. Through pensions, through insurance, through retirement savings. The risk hasn't disappeared, it's just harder to see. The deepest irony of the Basel Accords is this. In trying to make the banking system fail-safe, they didn't eliminate failure, they relocated it.
They pushed risk out of balance sheets that are monitored daily and into structures that are understood only in fragments, out of places with guardrails and into places with none. Basel didn't remove human judgment from banking, it replaced it with compliance. Loan officers became checklists, risk managers became model validators, decisions became numbers. This feels safe because numbers don't argue, models don't hesitate, rules don't panic. But reality doesn't care about compliance. The future will not arrive neatly packaged inside a spreadsheet. It won't respect historical correlations. It won't wait for committees to update formulas. The next crisis will come from a place the models don't expect, because that's where crises always come from. The tower still stands in Switzerland. The meetings still happen. The formulas are still refined. The updates still roll out. From inside the tower, the system looks stable. From the outside, something feels off. Credit is no longer primarily created by banks. Risk is no longer primarily held where it's regulated. Money is no longer neutral in a fractured world. And yet we keep measuring safety the same way. So the next time you hear that the banking system is well capitalized, remember what that really means. It means banks are full of government debt. It means lending has been constrained. It means flexibility has been sacrificed for uniformity. It does not mean risk is gone. The Basel Accords were never about preventing crises. They were about managing them, containing them, standardizing them, making them predictable. But the most dangerous risks are always the ones that don't fit the model, the ones that build quietly, the ones that live outside the rules. Somewhere beyond the reach of committees and capital ratios, the next stress is already forming. It won't announce itself, it won't look familiar, and by the time it shows up in the data, it may already be too late.